For this month, we're going to try cover some of these topics. One is the tariff strategy. That is one thing which is just constantly been in the news past couple months. It's currently under 90 days hold period, and there are a few places I think the government has already made a deal. But the tariff strategy will work out well if the negotiations are done more favorable way. I believe the current government is doing it. On a long run, it will be very beneficial for the U.S. government. I believe so, and I also listen to some of the leaders in the investment market. I think they are also sounding the same philosophy here. I think if the strategy works out well, the outcome is going to be very beneficial for the U.S. market, U.S. economy. We will see better numbers in the future, but the thing which we have to closely monitor is that how the federal government is going to execute this plan, a deal with every country in the world. The next thing is money velocity. Tariff war also caused some level of uncertainty in the market right now, and I think one aspect of it is that the money is not flowing in. That's one thing which we have to look at deeper. Why money is not flowing into the stock market? A lot of concerns there. Like there people are investors don't know what will be the outcome. There is some level of cautious steps out taken by the investors. They are keeping some of the money in the sideline, looking at past 3 to 4 weeks of trend. Any negative news, any delays in the Fed policies directly impacts the stock market. That is obvious impact it is. Nothing new there, but the fluctuation is too high volatile right now. That's kind of the state the investors are going through right now. So they're keeping money on the sidelines for now, cautiously investing it. Especially the technology sector has improved it, but we will see some more growth coming in. And the tariff is actually making a big impact. So money velocity is something we will discuss a little bit deeper. There are some data around that, and the S&P, it's all time high. It's close to all time high. So it is going to be in this state, but I don't think so. It will take the lead right now. It'll be cautiously moving on the sideways, primarily kind of churning to the sideways. And then when a favorable outcome comes out from the tariff strategies, tariff war with other countries, you might see hitting the all-time high. So keep an eye on the S&P, and as well as the spider sector ETF. So that's also kind of directly correlates with the tariff strategy here. And then we'll cover some of my dividend strategy numbers. How much I have achieved after June month, and I think it just covers it now, a complete whole year of dividend plan. I am somewhere around 37 percentage. If you remove some of those losses out, then I'm somewhere around 31 to 32 percentage of growth in my 100K investment. Plus my investment also kind of multiplied because I kind of opted to reinvest the dividend back into the same company. So the investment is also went up. So that is what we're going to cover today. The first topic we're going to cover is the money velocity. Some of the insights I have is kind of coming from some of these federal charts and data, which is publicly available. So anyone can look at the data. I will share some of those sources also in my slide. The first thing is about the money velocity. What does this money velocity mean to us? And I think money velocity is the rate at which money circulates in the economy. I think that's the key part. It impacts the spending. It impacts the economic activities. Bunch of things tied up to that. So that is one thing. Some of this Fed closely monitors, saying how the money velocity is inside the market as well as on the spending area. This has an impact on the overall economy direction. So some of the indicators are basically, if you have a high money velocity, indicates that there is an increase in the spending, and there is a economic growth is there. And especially if you see investors are investing more money into the market, so that is kind of a positive sign to market as well as the economy, that it is trending in the right direction. And if you look at the other way, which is the lower velocity, means that some level of stagnation is there. People are trying to save. They don't want to invest money into the market. They want to keep the money ready on the sideline. Once all these uncertainty, volatility gets settled, then people will start investing. I think that's where we are seeing right now. Current state is that even though S&P hits the all-time high, close to all-time high, it doesn't mean that people are fully invested in the current market. I think if you look at some of those numbers, the velocity actually gone down. I will share that chart too. Some of the recent trends are basically looking at the chart there. basically it has gone to a peak, and then it is stagnating right now. That is the current state at which the Fed, Fed data is reflecting that, the money velocity has actually kind of stagnated right now, or moving in the sideways direction. So that's kind of a high level thing. So the recent trend shows that a lot of fluctuation currently going on in money velocity, reflecting some of those changes happening in economy. Tariff is playing a big war here, with the I know the federal government, Trump President Trump is actually working out the deals with individual countries. It is actually playing a big role in this money velocity going down. So due to a lot of fluctuation, people are not circulating money. They are saving more right now. They're keeping it in the sideline, and that's very evident right now. And that actually reflects how the consumer behavior is. Here's a chart for the recent money velocity published by Fed, St. Louis Fed, and you have the source here. It's called the Fed star St. Louis Fed.org. This is a site where you can find a lot of this economy data there. Fed closely monitors this data. They publish this data on a regular basis. So this is publicly available data. So you can look at this, understand how the economy is doing. So by looking at this one, it is called as the velocity of M2 money stock. M2 money stock, basically what is M2? M2 means it's a combination of M1 saving accounts, money market and funds, CDs, shared certificates, a bunch of things. These are basically individual accounts uh, maintained by the household people, and they're depositing money into these accounts. And these are primarily, Fed closely monitors how things are moving in the economy. I think that is what they wanted to look at it, to understand what is the spending style, consumer spending activities here. They're looking at very deeply, very closely these accounts to say, hey, is the is the deposits are going up, or do you see people investing in the stock market or in the economy, or they're spending money to buy stuff. Those are some of the measures they look at very closely. M1 is nothing but basically the cash and check deposits. And then kind of M2 groups all of them, like the cash, check deposits, saving accounts, market funds, money market funds, CDs, and other stuff. So this is basically looking at, Fed is looking at all this data, they're depicting it, kind of putting it into the chart. And some of these gray sections are, the history goes back to 1960 onwards. These gray ones are primarily the recession period. So in the recession period, you could see that the trend in the recession period, you could see a level of slowdown, as a sharp slowdown in the spending, or basically investing it in the economy. People are saving more than ready to invest. That's very evident in every recession period. You could see when the recession starts, people just don't put the money back into the economy. So that's kind of a trend you can see. And every recession period has a downfall of this. And if you look at the trend past, from since 2000 onwards, it's always in the downward trend. And you could see there is a spike pullback, good economy in 2005, 2008. We had a financial breakdown that actually brought some of the recession back uh, into the market, which made consumers to be very cautious and start saving money rather than putting it back into the economy. That was a steep fall. And then there was a recovery in 2010. Gradually, people were knocking off money into the market. So they were saving more than investing. And then we had a 2020 pandemic period. There was a steep fall down. It was for a short period of time, we kind of had a recession, very a minor recession there, which had again an impact in the consumer spending, as well as the savings were going up, people losing money. So those are some of the factors caused some of this money velocity going down. And then since 2020, there was a good decent recovery, but of late that recovery also stagnated. And very recently, some of the tariff strategy actually caused a big impact on how consumers want to spend their money going forward. Do they have a confidence in the economy? Do they have uh, things to invest on? Those are some of the things people are struggling right now to figure out, because they clearly don't know which direction the market is heading or the economy is heading. They are kind of in a waiting mode. Once they get a good news, you might see some volatility there, spikes. That is very clearly seen, but we don't have the granular data. You could see some spikes here and there, but overall, people, if you look at the velocity, is stagnated here, which means that people stop investing money in the market or in an economy. which is similar to that peak. I believe that hit the peak. um, if the tariff strategy or the outcome is positive, then you might see a spike up. If not, there's a good chance that going down. So this is kind of a velocity, shows you how money is moving into the market. And right now, looking at the trend, I would predict that the spending should go down further, but it depends on what the tariff is going to lay out in the future. Next 2 3 years, it's going to show us how the economy is going to recover, right? Or we might enter into this gray zone. Gray zone, basically, it's called as the recession period. So what's going to happen next, we don't know. We have to wait and see how the tariff thing works out. So this is kind of a high level about money velocity. So this is one measure to closely monitor. We have to see again, a couple of these data points are, um, they don't publish it on a regular basis. Monthly once or 2 months once, you might see these changes or data getting published. So keep an eye on it. Whenever it gets published, I will bring it in my podcast too, or in my YouTube channel. So some of my future videos will also cover this money velocity. So this gives you a better sense of how people are looking at the current economy, whether they're ready to invest or not. It just goes, if I take my example, I'm not fully committed in this current market right now. I do have some cash kept in the sideline ready for investment, and I am watching at what the tariff things, how things are moving. If the outcome is good, I'm going to put the money back into the market. If not, I'm going to keep it sideline, or maybe look for some other opportunities there. So that's kind of the overall money velocity charts is going to, it's telling us what to do in this market. The next thing which I want to cover is like, what is my current achievement right now? Like, what did I get out of this dividend strategy, which I've been doing it for past 1 year. And if you see the numbers which kind of highlighted here, it clearly shows that I've been committed to this dividend strategy since July 2024 onwards. I've not done any swing trading in this whole year. Maybe once, I would say, kind of I was carried away with some of the market movement. I kind of invested it in one of the company, took some money off. So that number is not showing up here. So I kept that one separate. So it's not part of the dividend strategy there. So looking at some of the numbers past 1 year, like 39K out of my 110K investment, pretty decent one, close to 40 percentage return, which is a decent return. And again, this is all pre-tax numbers. So whatever whichever tax rates you fall, you could basically take out the portion of from that return, from this particular return. And then if I would have stayed disciplined, I would have saved this 7K too. So I kind of removed that 7K. The 7K is kind of a loss which I incurred in some of this initial stock purchases I did, the dividend stocks. um, to be honest, I didn't have the conviction on some of these stocks because they're paying you high, but I'm not sure how those companies are performing. So it took some time to figure out some of these companies, whether they are pretty stable companies or not. And if you have seen my previous video, I've covered some of my learnings also, part of those videos. So take a look at it if you get a chance. So conviction was not there, so I had to take some loss, kind of hit, incurred some losses there. But after that, once you system gets matured, you tend to follow the process. So the process is very important here. You purely invest that money into a dividend paying stocks. Keep iterating through, find the new stocks, research continuously, research on finding new stocks where you're getting a better dividend, right? So that is part of my process. So I've been investing in dividend for past 1 year. Growth is good. If I remove this 7K loss, the total return has come down to 32K, which is kind of 31 percentage return. It's not a wow return, but at least a decent return compared to giving it to a fund manager and managing it. So I'm doing it by myself. Anyone can do it with some tools. Using the tools, some of these tools like the trading views or other fidelity tools, you could probably analyze, find the stocks which are paying you good dividend, uh, good leaders in their sectors, and could achieve a similar numbers there. So next year is going to be, so whatever I learned this year, I'm going to get better at it. Probably refine it slightly. Maybe find even better stocks to invest and earn a little bit more. So my target is for next year is to achieve maybe a 5% increase in this current from the current number. So that's my target. But let's see how I perform. I will keep you posted as I do it on a regular basis. So this is kind of a dividend. But this video, I'm also sharing what are all stocks I've invested in this past 1 year. So that is going to be covered next. First time I'm going to share all the stocks which I've invested in past 1 year. I don't want to show this early because sometimes folks who are viewing my channel, my videos, get carried away. First of all, I don't know whether these stocks have been performing to the expectation, so I cannot convince the viewers to go invest in this. So first I need to try it out. That's my goal here. So some of my videos I've been doing, those have been tested by me. I've invested money in it, learned a lot in that investment, captured those in some of my videos, and I share it to my viewers. So it's the same strategy which I took for past 1 year. I've been investing in some of these stocks, and I wanted to be sure that I'm getting the right dividend before I can share these stocks to the individual invest to the viewers. So this is kind of the kind of high level, not high level, I would say more accurate numbers right now. Some of the stocks are kind of the Nvidia Y, which is nothing but the yield max kind of covered call strategy stocks. Some of these stocks are kind of high risk stocks. Definitely, I'm not recommending these stocks, but they pay you very good dividend. So if you are looking at the dividend strategy, take advantage of some of these high paying dividend stocks. A portion of your portfolio should have a little bit of risk, but they pay you better returns. And when you compare with the other ones, there are some stable companies or stable ETFs which I've invested in, like the SPLG, VWOB, VOO, uh, Pfizer, CVS, the Goldman Sachs one. Again, some of these S&P 500 ETFs. These are some of these ETFs paying you a decent return, but not to the extent of what these yield maxes are giving. So a combination of things got me to this number. Definitely, I removed some of those losses from this. This is after applying the losses. This is what my return is. And if you look at it, the total investment has also gone up 186 because at one point I've been invested in one company. Then whatever um, earnings I had from that, I kind of pull it out because they were not paying you enough dividend. So I kind of moved that money into another place, and then the money multiplied with additional dividend from the other companies. So that's how it ended up with the 186. Some of this money plus I put some additional money too. So the overall on these stocks, especially invested for dividend, this is what my current investment is. But the 32K which the dividend return which I had was around 112. So I brought in some additional cash into it because I have seen some good growth in those dividend stocks. So I brought some additional cash into it and taking advantage of those dividends, right? So especially looking at the return total ROI percentage, 34 percentage is on the Tesla Yield Max, which is the covered call stock. 39 percentage on the Coinbase. That's also another Yield Max covered call based model. Then comes the Nvidia. It's IEP. This is another enterprise asset management company. 8 percentage on the CVS. I just kept it for only 1 month. Got some 8 percentage, so which is a decent return. Then we have MSTY, MicroStrategy, Ilmax, Vanguard. The other ones, stable ones, they are pretty moderate dividend, but these are good stable companies. So you invest in it. Currently, the Pfizer has given me recently. They have given me kind of 1.53 percentage for this quarter. So if you leave it there, you might get a better return. So again, some of the dividend strategy is that just have some patience with these stocks. When you invest in, don't expect an immediate capital gain. They are going to slowly build up. So end of the year, if you calculate, you probably will be in a better shape. So the first thing which I learned from swing trading to this dividend based strategy is to build that patience and have some conviction when you are investing in some of these companies. You're making sure that you're investing it in the right place, right companies. There are other yield max companies too, but what I look at it is that, hey, which one is better performing right now? Nvidia is, right? So I picked up the yield max of Nvidia. Which one is the favorite in the market? Tesla. So then I picked up the Tesla yield max. Then Bitcoin has been the talk of the town, right? So I picked up the yield max. So some of these strategy you have to think through before picking up some of these covered call stocks. Those are kind of a level of risk is involved in some of these stocks. So identifying what is the market trend, favorites in the market, talk of the town kind of stocks, and then find those yield max and then invest in those dividend based stocks. So that's how I've been doing it. And decent return, I would say 32k out of 112. And some of those, those 32k got invested back into it, which is kind of 150k, 55k, yeah, 140 or 50k. And then I brought in another 20k because kind of I moved some of those investments amount into other stocks. So overall, this is kind of the return. These are some of the stocks which I invested in. I am researching on few more which I will be covering today. Let's jump into the other stocks which I'm looking into it for the next upcoming year. The next set of stocks which I want to cover for this month are Verizon. That is one which I'm going to look at it. They are paying a decent dividend. SPYI, again, this is also another high dividend paying stock. We will cover that a little bit deeper, saying where are they investing in. This is SNMPY index based dividend stocks. It's a premium ETFs, these are. And then we have a JP Morgan. Again, they are investing it in a kind of high income, premium, high income based ETFs, investing on SNMP stocks. So these are basic three stocks which we are going to cover. These are high paying dividend stocks, decent ones with the very reputed companies.
Starting with the sector performance here, sector performance uh, for Spider, it has invested. I think if you look at the holdings, it has leaders in every sector. Generally, Spider is evaluated based on how all these sectors are performing. Looking at the sector performance, I see technology has come back. It has come back to close to 10% here, followed by industrials and other sectors. Consumer discretionary is another one where it has recorded close to 8%. Past month, past quarter is 8%. But the technology seems to be the most performing sector in this month. And we have seen the investment has actually came back close to 11% growth. Some of the portfolio has recovered very well with this increase in the value. And you could see the where the money is, especially in this sector evaluation. You could see that the money is flowing into technology, and the heavy lifter is the technology sector. So when there is a downfall in the sector, technology sector, you could see that the whole market goes down. So this is a big influencer in the whole Spider ETF. Definitely, this month has improved. We could see some of the numbers have gone up. Market value is again primarily the capital gains, dividends, interest received, and reinvestment back into these sectors. Those are some of the parameters measured part of the market value total return. Again, looking at the market value, it actually improved to 10%, which means additional cash flow also happened. It has recovered 9%, but the reinvestment with the dividends and capital gains, plus some more money has flown into this sector, technology sector. But if you look at the other sectors, not that much. It's pretty much the same as the performance. If you look at the industrial, it's 8.85. The performance, total performance is 8.82 for the month. Just 0.03% has grown. So folks are not investing. Generally, the investors are not putting money into other sectors. They are seeing the technology going well. They actually put close to 8.08% cash into this particular sector. And if you look at pre-liquidation after taxes, this is primarily it's the total return of investment after accounting for taxes on, especially whatever dividends investors have received, dividends, capital gains, distributions before the taxes on selling gets applied. That's what it called as pre-liquidation. And definitely you could see that the same numbers overall looking at all sectors, technology kind of in the leading role here. And the same thing, industrial and consumer discretionary is the second level. Well, post liquidations at this stage is basically taxes are applied. If you look at some of the taxes, you could probably measure it close to 50% taxes have been applied on the technology sector. You could see. So the recovery is around 5.88%, and similarly for industrial and the other leading sectors. So overall, looking at the sector performance, technology has come back, which actually boosted the whole Spider ETF. Definitely, we can see that in the overall numbers for the Spider. Consumer discretionary is also another one. People are slowly trying to just take advantage of the situation. I think that's what they're trying to do. They're not fully investing money, but they're taking advantage of some of those downfalls of because of the tariff war. some of the sectors and leaders have actually downfall. So people are taking advantage of this downturn or the pullbacks. They're investing money slowly into these pullbacks, and I think it makes sense to generally look at our market right now. Find the opportunities where you can invest money, and especially the companies leaders who have got impacted due to tariff war, take advantage of it. Sometimes, when the tariff war gets over or the current government changes some of the policies to be more favorable, these companies going to boost up. So try to invest slowly in some of these pullbacks. Make sure that you invest in leaders in some of these sectors where you have some negative performance right now because of the tariff war. And and then once you start getting the positive news on those tariff setups or policies, these leaders will bounce back. So find out those opportunities and invest. So overall, I think the market is kind of performing okay, but cautious right now.
The stock which I'm covering right now is JP Morgan Equity Premium Income ETF. The ticker symbol is J for Jack, E, P for Peter, I index. So it's an ETF which gives you a pretty decent dividend. Looking at some of the numbers here, the dividend yield is around 8%, which is a very attractive dividend yield. And overall, for past 5 years, it has given you 12% growth, which is not so great return, but at least it pays you a better dividend too, and the dividend is also increasing too. And then looking at this particular ETF, what are they doing? Right, they're basically investing in some of this less risk stable companies in their holdings. So they're investing money in some of these solid leaders where you have less volatile. They're less volatile, and a steady growth with the minimum risk factor. Plus, to cover some of the income, high income, they are taking advantage of the covered call option strategy too. So it's a combination of things in this ETF. It's a decent ETF performance wise. 2003, it did have its own fall, and then it recovered. After that, it recovered close to 11 percentage, went into a sideways stagnation phase. If you have seen my other videos, 4 stages, very clear here. There's a good growth phase, stage two, then a stagnation phase, and then August 2024, market trends changed again, a good growth. Then since December 2024 onwards, it is in a negative trend. Definitely, it hit the all-time low somewhere in the April month. That's when some of this tariff wars or strategy or basically policies have put in by the federal government. Some of those tariff had an impact too. So overall, it depends on the leaders. But let's look at where they are invested in. If you look at the overview of it, they are kind of invested, diversified their funds in multiple sectors. First being the finance, around 16% invested there. Electronic technology 13%, technology services 12%. Top sectors these are healthcare, technology 12%, and the rest is all single digit ones. So these are top invested sectors. So when I look at some of those learnings, my learnings and the investment which I did past 1 year, I did invest in some of those risky stocks where the risk factor is so high, volatility is so high that some of my principal were going down. So I had to find stocks where it is stable enough, less risk, plus you have a decent size income too, a kind of dividend too. So this particular stock qualifies for it. Now let's go a little bit deeper into it. What are their holdings? So if you look at it, they're in Oracle, Mastercard, Visa, Meta, Microsoft. These are leaders in their own sectors. So they have invested in a right place. They're not kind of scattered everywhere. They're invested in the right place on the top leading stocks or leaders in their respective sectors. And on top of it, they're also doing some of the covered call strategy too to cover the income. So they have to pay the dividend. So how do they generate the money? By using some of those call strategy options. So covered call strategy options. So those are their strategy to cover. So it's a decent 8% return. And looking at the chart, there was a stagnation, then there was a peak. Again, some of those market trends dictate this price movement. It did had its own growth, and then since December, things started moving a negative direction because some of those tariff wars were kicking in and the sentiment was negative. So these stocks generally, our index were performing negative, and this particular stock is based on the index holdings, and it is going to correlate with whatever the S&P 5 um, index stocks trend is. So it's primarily following the same trend here. So it had a negative impact, and you could see that a, a big drop down in the April month when the tariff war really kicked in. That's when it had a kind of a downfall there. It went to the close to the IPO price range, and then slowly picked up the momentum once the tariff was put in hold. So it did recover its a portion of it, but looking at this level, 5960 is the overall number. Kind of a peak is 60, but interim peak is like 59. So it's somewhere in the mean right now. So the mean reversal. So it is trending here. If the tariff, if the tariff outcome is positive, good chance that it could kind of break that the mean level, resistant level, and it should perform better. If the tariff outcome is in a bad state, then good chance that it could go down. So find the pullback areas and invest in that. Find those pullbacks. You could invest now, slowly, very take a smaller batch of investments rather than dumping everything in one time. Take a smaller batches, in the sense, find the pullbacks and invest in. So looking at the moving average again, some of the trends are, uh, it is kind of in a sideways movement since May 20th onwards. It is in a sideways movement, so it should churn again. Moving averages here, 9 days SMA is in the sideways movement, plus you have the 20 days moving average is also kind of closely aligned with 9, and we have a 50 days which is kind of in a downward trend. So I'm expecting the stock should churn in a sideways movement until we hear something positive, and that would break this resistant level and should go up. So but they pay you a pretty decent monthly dividend of 8%, kind of 8% is annual. So you split that into 12 months, and that's what you're going to get out every month. So it's a pretty decent stock, decent holdings, and good dividend paying stocks. So look at it. Uh, The next company we're going to talk about is a company called Verizon. Verizon, as you guys know, they're primarily in the communication business, and especially what I've seen with these types of stocks, communication sector stocks, example AT&T, Verizon, and other folks. Especially when there is a market negative trend is in progress, there will be an investment in these types of companies because they pay you a decent dividend. And if you look at AT&T, if please check out my other videos. I did cover AT&T in my previous videos. So it has a pretty much similar product line, and slightly better dividend than Verizon. AT&T gives you close to 7 to 8% dividend. Verizon gives you somewhere around 6 to 7% dividend annually, and they are quarterly based dividends. Their primary products are communication products. If you're kind of mobile carrier services and other things, so those are their primary business. Looking at the price movement, they were kind of in a sideways movement for the entire 2024. Since early till the end, they've been in the sideways movement. They did spike up, but didn't last for a long time. It did had its own downturn once the new administration has taken over. It did see a steep downfall, hitting close to how much, like close to 20% down. That was kind of significant, close to like 12 to 15% down, and it came back again once, kind of around Jan timeframe. The price movement started going up. That's when the more negative sentiment was prevailing in the market, and especially when you have a negative sentiment, investors, what I've seen is that they invest money into some of these communication sectors where they're paying you a decent return, because customers are not going to get out of these communication. Every individual customer needs some way of communication, so that is their primary driving factor here for revenue. So investor investors also know about it. They invest money into this type of companies, where when there's a negative trend in the market, you see a positive growth in these companies. That's what we have seen. So there was some negative sentiment. It did grew very well, close to 20% recovery, and then it kind of sustained within that time frame. So it's kind of tunneling down now, right now, because it has seen enough growth, but people don't want to take money out of this company because of a very attractive dividend here, close to 6 to 7% dividend. From the earnings standpoint, they've been doing pretty well. They have never lost their ground in some of the earnings. They were consistently on par or above par with the expectations. So that's a good sign that this company is performing well. Overall, it's a very good dividend paying company. Close to 64% is the payout ratio. That's a very decent payout ratio. Consistently, they've been paying this dividend decades. So it's a decent sized company. From the volume standpoint, they're close to the high peaks are around 60 to 70 million shares getting traded in a day. But in an average, they are somewhere around 16 to 20 million shares, which is a decent size, a decent volume. Off late, if you look at some of those, there are more accumulations than distributions. You could see more green bars than the red bars, which means that it just clearly shows you that investors want to take cautious route. Find the stocks which pays you a decent dividend and can sustain in some of this negative trend or negative sentiment market. And these communication sector companies or the primary companies to go invest in, where you get a decent 6% growth. From the technical standpoint, it did have a bunch of quite significant cup shape pattern price recovery, and similarly we had another cup. But if you go a little bit deeper into it, there's an inverse head and shoulder pattern here. That's another one sign which tells you that the price is moving upward direction. So if it is on the normal head and shoulder, then the price is moving downwards. If there's an inverse, then your price is moving upwards. So that's another pattern to look at it. I closely monitor some of these technicals, and I think it has shown that pattern. And in the Feb 2025 timeframe, you could see that there's more negative sentiment in the market. People are bringing money more into this sector. So there are more accumulations happening since February onwards in this sector. So investors have clear view or what's going on in the market, and they have put money into this, and and taking advantage of the dividend. So overall, it's a very decent company with a decent, very kind of attractive dividend here. And the fundamentals are pretty good. There's nothing negative about this company. When the sentiment changes to positive, that's the time where you can move some of the funds out of this company. At that time, you will probably see some negative trend in this company or in this sector. So keep an eye on this one. Take advantage of this dividend what they're giving you. Overall, it's a good performing company. Another high-paying dividend stock is NEO's S&P 500 I Income ETF. They are an identical SPX indexed holding, in the sense like the stocks which they are holding right now under this ETF will be identical to what SPX index is. They're basically following the same holdings, and the trend is also going to be pretty much same. If you see S&P 500, S&P 500 falling because of the negative trend, you will probably see the same behavior on this stock too. So pretty much the same trend you could see. Looking at the price movement there, since October, it has grown significantly, around 16% growth. This is a good time to invest in. October 2023 timeframe was a good time to invest. You would have probably seen a good capital growth of principal growth of 16%. It did had a churn, kind of a cup and handle pattern kind of recovery with a 4% depth, and then the handle couldn't take the negative turn, kind of negative trend in the market, which actually couldn't recover. The handle was setting up but couldn't recover because of the negative trend. It did had a significant fall, similar to what we have seen in the S&P 500, and then in the April timeframe is when you could see that the downfall was very steep. And once the tariff, it's primarily because of tariff. Once the tariff was put on hold, it did see you could see that there's a V-shaped recovery here, similar to what we have seen in the S&P 500. So it has not hit the peak level, which is 52 points. It is close to the mean. You could see that it has kind of bumped out of the mean um, numbers. There's a pullback. If the pullback comes again, like in a sense, if the recovery is good, you could see that the price movement upwards, then it's a good sign that that the trend is changing. So it is changing to the upward direction. If it couldn't hold off on this level 49.59, if it falls down below that, good chance that there's a negative trend is impacting this price movement. So you should see some level of sideways movement here, and then gradually going down if the sentiment continues. So currently it is in a sideways movement for now. So watch out for that a pullback. If pullback happens, put some smaller batches of your funds there. Buy smaller batches of shares here. If the pullback doesn't recover, then wait for the next pullback time where you could see that positive kind of trend, upward trend. Then take advantage of it. So For now, again, this stock mimics what the S&P 500 is doing. Now, looking at the dividend, our focus is towards the dividend. This pays you a very attractive dividend, which is close to 12 percentage, and it is a monthly dividend payment. So if you're looking for a passive income, this is another good stock to invest in, so which will multiply faster. So they split this 12 percentage into 12 months and distribute the dividend to their investors. So it's a decent stock, mimics S&P 500. Looking at some of those funds allocation sector overview wise, it pretty much identical to S&P 500. So you could see that electronic technology 20%, technology services 20%, finance 15%, so on and so forth. The other ones are not significant, but these are top three sectors where these funds are invested in. And looking at a little bit deeper into the holdings, all the leaders are there. You can see the Microsoft, Nvidia's, Apple's, Amazon, Meta, Broadcom. These are top leaders in their sectors, in their respective sectors. That's where this particular stock has invested. So now, from the risk standpoint, it's not significant risk because they've invested in the leaders, and the leaders are performing well right now, based on whatever happening in the market. So it's a decent stock, where it has put money invested in the right set of leaders. So that gives you more confidence, more conviction on this particular stock. Plus, on top of it, it pays you a dividend to close to 12% dividend or 13% dividend, which is a decent size, very attractive dividend. So from the overall stock standpoint, this is a pretty solid stock. Now, how do they generate revenue? Again, how do they generate this dividend income? It's based on covered calls options. Pretty much every stock right now which pays you a higher dividend, they get that dividend or they generate that income based on the covered calls. So there is a risk factor here, but if you look at their funds allocation, they are allocated in the right place. So it's a decent stock with a very attractive dividend. If you're looking for a passive income, if you're retired or close to retirement looking for a passive income, you can invest here. If you're building up your wealth and you're okay to take a little bit of risk on a smaller allocation of your or a smaller percentage of your portfolio, which could multiply faster, this is a stock to invest into. So you get a very good 12% dividend, and it multiplies faster on a monthly basis. So it's a pretty decent stock. Take advantage of those dividends. Thanks for watching my video. Stay tuned for more updates, more interesting topics to cover in the future. Until then, stay invested. Thank you.